You guys are currently living on 80,000 of income per year. Having everything a little bit better than where it's at currently, we're able to get it up to 160,000 of income that you can be spending per year, doubling their income from where they were at today.
In your working years, you save, you invest for 30 to 40 years. You're considered a long-term investor. Then you get to retirement, and more people are in retirement for the same amount of time, 20, 30, sometimes 40 years. Yet we're not considered long-term investors in this space. We got to change our thought process. But to what? This is an interesting conversation because, as I was just saying, Frankie, we're living longer,
Yeah.
and we have to plan differently than our parents and grandparents did for retirement because of that longevity. But we also have to change the investment philosophy because we can't invest the way we were investing in our working years. So why are we not considered a long-term investor then at this phase of life? And why does our investment planning have to change?
Well, I think you still, in some aspects, are considered a long-term investor because like you're saying, Heather, you might be alive another 20, 30, 40 years in your retirement. And so some of those funds you're not going to touch for a good 10, 20, 30, 40 years. And so with those funds that you're not touching for a while, you can invest those long-term. But what changes from the time that you're in your working career versus the time that you're in your retirement is that now you're going to need to start taking funds out of your investments. And with those funds, you're no longer a long-term investor because you need to start taking some of that income out. And so you want to have some of the portfolio in a position that you can take that income out without long-term repercussions, without problems for the future of the portfolio. For instance, let's say you had all of your funds in the stock market, and you're in your 20s, your 30s, your 40s with another 10, 20, 30 years until retirement, well, that's not a problem because when the stock market crashes, notice I said when, not if.
Right.
These stock markets crash on average every 6 to 7 years.
Yeah.
There's a decline of 20% or more on average. And so this is something that we see very frequently that you're going to probably see another 3, 4, 5, 6, 7, 8 times in your lifetime are those stock market crashes where they go down 20% or more. And so if you're in your working career and this happens, you're okay because every time that crash has happened, that market has reached new heights after that. And overall, you've averaged a really strong rate of return all the while. And so it's not a problem. You don't need to change anything in your 20s, 30s, 40s, and early 50s. But as you're getting closer to your retirement years, if there's a stock market crash right before you retire,
Yeah.
that can mess up your plan big time. Because let's say you had $1 million in your 401k, and then it's 2008, the stock market goes down 50%. You want to retire in 2009, and now you're at $500,000. That's going to make a huge difference in your retirement. Now you have half of the amount of money to be able to draw that income from.
Right.
So as you get into your retirement years, you need to shift some of the risk. You need to have some more balance in the overall portfolio. You don't want to have it all invested in the stock market because if there is that crash of 50%, and again, this is a worst case scenario here that we've seen in the past 20 years,
Right.
is a 50% decline. But if this happens, well, we need to be able to draw from a portion of the portfolio that hasn't lost money. You don't want to sell low on the market investment because once you start doing that, then it's going to take even longer for that money to recover when the market comes back up because that money that you take out, that doesn't go back up because it's out. It's no longer part of the investment earning money for you. And so you want to change some of the way that you invest as you get closer to your retirement years. And so what we do here at A Better Way Financial is we set up some of the portfolio where it has market risk and some of the portfolio where it has no market risk. And with those market investments, you're going to get returns that are very similar to the overall stock market. That's at least the design of the portfolio, is to mimic or get close to the overall stock market. But with the other part of the portfolio, you're likely going to earn a little bit less than the stock market. Why? Because you're not taking the risk of the stock market. So because it's not getting as much risk exposure, it's also not projected to get as high of a return. We're looking at roughly about 1 to 2% less in overall return, which is still a very decent rate of return for money that's not going to have any losses when the stock market goes down. Now, how much should we have in the market account versus how much we should have in the no market risk investments? Well, that depends on your personalized risk tolerance. And we do a discovery meeting where we get to really understand where you're coming from. What are your goals? Maybe you had a 2008 experience and you lost 50% and you said, I'm never going to invest that much in the stock market again.
Yeah.
Maybe you had a different experience. Maybe you've seen, okay, well, the market goes down, the market comes up, and I've averaged a really, really good rate of return, and I feel comfortable having more money in the market. These things are different for everybody. Not everybody should have the same risk tolerance. And so we gauge what your personal risk tolerance is. And then when we design that custom made retirement portfolio for you, we make sure that you're not in a position where you lose more than you feel comfortable with. So we look into your specific circumstances and develop that retirement roadmap showing you what we can do to get you the income that you need in your retirement years while not taking more risk than you feel comfortable with.
Okay. Obviously, it's a big conversation because I think about how we are taught to be in our working years. When we start out, at 22 years old, then you arrive on retirement's doorstep 40 years later, and suddenly, in the snap of a finger, in a moment in time, you're supposed to know how to completely shift your mindset. Well, no, of course you're not. So, can you share more about an example of how that works?
Yeah, I'd be happy to. And so this is something people are calling in, on the radio show, or we're doing these dinner workshops. They come in, they get referred to us, and we talk about, well, where are you at? What does it look like? What can we do to help improve your retirement?
Yeah.
And so there was a couple that came in, they were referred to us just the other week. We talked about their financial situation. They did an excellent job saving. They saved around $1.6 million for their retirement, and they needed roughly about 80,000 of income per year.
Okay.
And so what we did is we looked into how your portfolio is performing, if there was anything that we could do to improve it. Over the past 25 years, they were getting a decent rate of return, around a 6.5% rate. But the level of risk was more than they felt comfortable with. It was around 32%. They didn't want to go down more than 25 to 27%. So we
Did
said,
they
all right, well, let's take.
know that the risk level was that high when they first came in, or were they kind of feeling like, we think that it's too risky, we don't know, and this is where you come in with the math?
Well, most people don't. Most people don't know where they're at as far as risk goes. They don't know, am I taking more risk than I feel comfortable with? Or sometimes they do and they know that they should take less risk, but they didn't really know how. They don't
Got it.
know what investment options they
Uh,
have. They're like, well, I don't want to invest in a bank. I don't want to invest in CDs or savings. Those don't really earn me a lot of interest.
yeah.
And I just want better options.
Okay.
And so that's why they come here. And we talk about, well, what are the safe money options that you can get a better rate of return? And so we look into what we can do to get a good rate of return on the market side, what we can do to get a good rate of return on the safe money side. This is primarily using fixed indexed annuities instead of the bonds, or instead of other types of structures such as CDs and savings accounts and things like that, can usually get a better rate of return for our clients
Okay.
while not taking any additional market risk with those funds. And so looking into how do we strategize, how do we get the highest rate of return that we can while not taking any more risk than our clients feel comfortable with. And with this couple, we were able to structure it so that they were able to reduce some of that risk and still get a higher projected rate of return over that 25-year period. Instead of around a 6.5% rate of return, we were looking at about a 7.7% rate of return over that same 25 years. And
Okay.
though that doesn't sound like a huge difference, in dollar terms, we're talking about $21,000 more of income per year, of extra interest per year. So
Really?
that can really make a
Yeah.
huge difference when you're compounding it over a 10, 20, 30, 40-year time period, such as retirement could be. And so when we set everything up the right way, when we looked into their tax picture and showed them what we can do to save money in taxes, we were able to show them how to save over $275,000 in taxes over the course of their retirement years. And just looking at it from that lens of what can we do to make your retirement better?
Yeah.
And so when we looked at that, we said, hey, you guys are currently living on 80,000 of income per year. Having everything a little bit better than where it's at currently, we're able to get it up to 160,000 of income that
Really?
you can be spending per year. So an extra $80,000, doubling their income
Wow.
from where they were at today. And
Not
so
by
that
saving more, just by adjusting the plan and implementing tax strategy and different risk strategies.
exactly, Heather. That's all it was. It wasn't like, oh, now you have to save hundreds of thousands of dollars more to be able to get these results. It's You already did your savings. You did the hard part.
Yeah.
Just come on in and let's see what we can do, what minor changes we can make
Yeah.
to make a huge, major impact in your retirement. Maybe you can spend twice the amount that you're currently spending as it is in this case with this couple. Maybe it's not that drastic. Maybe it's only $10,000 or $20,000 more. But hey, $20,000 more of income per year. I mean, wouldn't that be nice? What if you won a small lottery
Yeah.
where you're getting $20,000 more that you have to spend every year? I would sign me up for that. That sounds awesome.
Yep.
But all you have to do is see where you're at, see what you can do, see what can be improved. And if you want to learn what we can do for your specific circumstances, go to our website, abetterwayfinancial.com, and we'll be able to set up a time to go over your personal circumstances and see what we can do to help make your retirement better.
Well, as Frankie was pointing out, there are lots of options, lots of opportunities in regards to how to change your investment philosophy, but it can feel intimidating and overwhelming when you're trying to figure it out on your own. Good news is you don't have to. At A Better Way Financial, they are here to help. They're doing it every single day. They're here for you as well. So let's begin the conversation, helping you understand how much more income could you be living off of every single year in retirement. You got to do the math for you because it's different for every single person that Frankie and everybody at A Better Way Financial meets with.
Give us a call, 610-440-3722.